Hi, everybody. Welcome to another chapter of the Mirrors webinar series. This one today, we're talking about strategies for profitability in aged care. And many would say that's the elephant in the room, and we shouldn't use the P word if you're not for profit, as a lot of the industry is. Obviously, we're talking about surplus, we're talking about excess, we're talking about not trading negatively. We're talking about not for loss. So how is the industry going to continue to make ends meet, if you want to put it like that? And there is troubling signs in some ways, and there's also opportunities in other ways. So we thought it was time, especially at the end of the financial year, to get a group of people together. We've had AN-ACC in place for 18 months now. So we have a really good idea of where that's going. Mandatory minutes is coming in, 215 minutes coming in. So we've got a really good idea of where we're going, but we're waiting for task force report. We're waiting for we're waiting for the act. We're waiting for a lot of detail about how we create certainty. But we just thought it was time to start having a discussion, get people thinking about what is driving profitability and where are we going with that. So hopefully you'll find this hour really useful. Quickly, just want to make our acknowledgement of country. We obviously acknowledge the traditional custodians of the country throughout Australia and the connections to the land, sea, and community, and we pay our respects to the elders past and present. Extend that respect to all Aboriginal Torres Strait Islander people today. Lovely piece of artwork that we now use for that. Just a reminder that this does qualify for a CPD for those of you who collect them. 1 hour, 1 point. So please register that. We have our chat going. We've got people monitoring our chat. We really appreciate all of you putting your comments, putting your thoughts, reacting to the content, telling us what else you want to know. We do review all of the chat questions, all the chat information. At the end, if there's anything that's popped up in the chat that we think is really important, we've got time, we'll put that to the panelists. Yeah, please put your information in the chat, and remember to send it to everyone rather than just the panelists, so everyone can see your questions and your comments. That's really useful. And like I said, we have people monitoring that. So if you've got a simple question, you might get it answered straight away. Our usual format, we're going to go through some poll findings. Many of you responded to some poll findings on the way in, as you usually do. So we'll have a quick look at those. We'll hear from Tyler, as usual, with some data insights to get our conversation grounded in some facts. Then we'll talk to the panel about where they've got to so far up to this point. I'll go through some key focus areas that you can think about, certainly the conversations we've been having with providers, and then we'll go back to the panel and really round out the conversation, talking about where are we going next, what are they doing, and where are we going next. So that's what we've got in store for you, as usual. So firstly, the poll results. We asked 4 questions. The first one was, we just asked a general question about whether you think your business is financially better off under AN-ACC than under ACFI. We thought that's a really important question. There's a couple of nuances to this, but has it gone far enough? And I think what's really interesting about this result, sure, there's 54% who agree or strongly agree that it is, but they are better off. But there's also that 36% who are not sure. And we think that's a really important indication of people just waiting and seeing. We've had a lot of funding bumps and care compliance is kind of in its early days. So a lot of people struggling to get their rosters in balance with their funding still. So and that as that margin shrinks, as that care minute compliance comes up, what will happen to profitability? That is really the reason we're here talking today. So that's very representative, that 36% right there. The future profitability and viability of my business will depend mostly on non-care income. So if you take the funding there, the care funding that makes up 70 or 80% of your income, then the rest of it is sort of 20%. So one of the things that we've started to acknowledge is most of your funding, most of your income comes from care funding, but a lot of your margin and a lot of your surplus will come from non-care funding. So what does that mean now? Do people agree? So 50% agree, strongly agree, but then even bigger, not sure, 44%. Results of the response to the task force, the new act, all of things that might be changing over the next year or two that will dramatically affect non-care income, your ability to leverage things like consumer-based pay. That's really the big question now. And so even bigger, not sure. And I think that's really telling. One of the reasons we leave that not sure option in there is because we really do like to see how many people are undecided at the moment. We will be actively reviewing alternative strategies for profitability surplus over the next 12 months. I think this is really, really telling as well. It's strongly agree. What's that? 81%. So 81% will be looking at their profitability and their surplus or surplus over the next 12 months and trying to understand what possible alternative strategies are. So does that mean that people are always doing that? Maybe. But it's a very, very positive response to say that people are actively, and definitely reflects the number of conversations we're having around profitability and profitability analysis at the moment. We've done more work in the last 3 to 6 months than we've done in the last 3 to 6 years in this space, it feels like. And the last one, apart from non-care funding, the most important factors to future profitability will be, and we listed out a lot of the ones that we're talking about. Obviously, accommodation prices going up, certainly in line with the average value of properties, hasn't really kept pace. Increasing consumer contributions, increasing revenue from additional services, increasing the percentage, if that's one of the recommendations of the task force, increasing, keeping a component of those deposits as an income source, other innovations that are not currently in place, other services or other possibilities, or a combination of all of those. And what's really interesting is that very large proportion of people selected a combination as being probably the most important thing. And I think that is very telling. Sure, the increased consumer is 14%, and increased revenue from additional services is 15%. And other sort of 12%, but really a combination of those. So people looking for widespread innovation in a number of areas is contributing to their future, I think is really telling. So really, really interesting results there. I'll hand over to our sort of resident data guru, Tyler now, who's going to take you through some information about that's relevant to profitability as far as we can see from the data that we have. Tyler?
Yeah, thanks, Andrew. And the poll questions there, the responses I think were really interesting, and I think align really well to what the data is telling us. And access to the entire industry's QFR data certainly provides insight into many operational challenges. Here on this slide, we're looking at the amount in which each service was in surplus or deficit, and that's measured by in per resident per day, and the industry average we can see sort of right in the center of the slide there was a deficit of about $11 per resident per day, and there may be sort of a compulsion to see what that looks like if we annualize that across 190,000 residents. It comes out to well over $700 million of loss for the industry, but that is that $11 is a simple average across all 2,500 plus facilities, and of course not every facility is the same size. The actual deficit reported across all financial reporting was closer to 140 million. So not as daunting, but still a considerable deficit to overcome. And beyond financial performance, we also have access to the quality and compliance measures for each service. If we group services based on their staffing performance and then compare their financial performance, we see that most of the industry is in deficit, and seemingly for the sake of compliance. And that's based on the fact that the average performance for a minimally compliant service, so that 3-star rating, is a deficit of almost $5. And that, as you can see, only worsens as staff ratios increase. So you see in the 4 and 5-star averages, the deficit is much higher. Throughout this data, you may notice there are some anomalies, particularly in the 5-star rated group, and that's just largely due to the fact that there's so few services with that rating. But below that, if we group services based on their financial performance, so in that quartile grouping of the average surplus or deficit, and then compare their staffing compliance, again, we see that as staffing increases, surplus turns into deficit in an almost perfectly inverse correlation. So with a perfect correlation having a coefficient of 1 and an inverse correlation being -1, the correlation coefficient for this data is negative 0.9897. So it just tells what I think what we already suspected, but the numbers that we're able to analyze have just an overwhelming agreement with what we would already say we knew, that to achieve that care minute requirement essentially requires us to go into a deficit. And I guess an extension to that, we'll look on the next slide, using that same data for financial performance and staffing. We're now going to overlay the average resident contribution for each service. And this too shows really strong correlation to both compliance and surplus. And again, that there's some anomalies down in that 5-star staffing, and that's such a small number of services that we're sort of comparing. But in the center of that table, where we have a huge majority of the industry, it's clear that healthy financial performance within the constraints of compliance is largely a result of resident contribution. And so really what this is telling us is meeting the care minute requirements leaves very little AN-ACC funding left over. Services have to roster almost perfectly and manage AN-ACC perfectly to align to the roster just to not be in deficit. And any unforeseen event, a large number of departures, or a big spike in sick leave that sends you to getting an increase in agency time, it quickly sends a service into deficit or non-compliance. That's your choice. You can either spend to maintain compliance or go non-compliant for lack of trying to boost up the roster. So that's the balance. Essentially, the government wants perfect compliance with break-even pricing, and I think that might actually be the motto for Medicare. But where does that leave providers when they're unable to sustain perfection indefinitely? They have to look at that consumer contribution to fill that void. And really that aligns to what the government has been saying for a long time. Finally, I just want to provide a quick glimpse into our thinking regarding the upcoming NWOW price adjustment. Last year, when the Fair Work Commission announced an interim increase of 15% to minimum wages for direct care workers, the Commonwealth promised to fund the outcome and did so by incorporating the increase into the NWOW price. The pricing advice provided for last year factored in that 15% minimum wage increase, but many of the eligible workers were already paid more than that minimum wage. So it couldn't be treated as a full 15% increase to those workers' wage expenses. Came out to, when we looked at that Fair Work increase along with inflation, we ended up just over 12% increase. So the NWOW became $243.10. But we then saw an additional increase in December. So they tacked on another 4.5%. And so that secondary adjustment combined with the delay that we're seeing to this next indexation. So obviously we're not going to get a price increase in 1st of July. It'll come in October, but even in the lead up to the budget, it wasn't clear if the price was going to change in October or potentially at the end of the calendar year. So all of this sort of leads to the idea that the government is taking an incremental approach to pricing. And so I think if we assume a similar approach for the new financial year, then the new price should incorporate the observed inflation along with the Fair Work Commission aged care work value case decision. This could mean an initial indexation of anywhere from 8 to 12%. And then again, there's the possibility of a secondary adjustment. So if we see, a price increase of around 8% in October, we may see another 4% in April. And really, it's that first price adjustment in October that will really tell us how likely it is to see another adjustment later in the year. And that's the data. Back to you, Andrew.
Yeah, thanks, Ty. And I think some of the key messages in there, it's not about doom and gloom. It's about the fact that the AN-ACC model is built to deliver very narrow margins, much narrower than ACFI, which, as Tyler pointed out, makes it difficult you really need to have your AN-ACC balance and your AN-ACC processing tightly managed in balance with your care minutes. But really, it's about looking for a more holistic approach. We met with the department just a couple of weeks ago and talking to Mark Richardson, and said we were doing this webinar and we're doing a lot of work on profitability analysis and looking at the areas of non-care funding. And he was really supportive of that. He said needs to be a holistic approach and taking a look at that. We'll talk more about that a bit later. But for now, let's go to our panel. We love having a panel on board, and we've got a great panel today. East Coast, West Coast, large, small, really, and a mixture of roles there as well. Executives and Tim's one of, apart from our own Tyler, one of the great data kind of commentators in the industry at the moment. So we'd love to have Tim on board to give us some insights. And I think David might be struggling to connect, so we might have to come back to him at another time. But thanks, Chris and Athena and Lee and Tim for joining. The question I wanted to ask you now is just to give us the story of the recent past, the last 12 months or 18 months, with the new AN-ACC on board and everything else that's been going on, wage rises. What's your organisation's approach been to this point? We'll come back to you a bit later to talk about what you're going to do going forward. But to this point, what's brought you to this point? What's been front of mind? How's your organisation been coping with this question about profitability? Let's start with you, Chris. Let's go left to right.
Thanks, Andrew. Look, it's probably good for me just to start by saying, as a for-purpose organisation, and you opened up with this, is the commerciality and the profitability of the organisation is absolutely critical. For us, it's the enabler. It's the enabler when it comes to supporting our care and our workforce and our people at those outcomes. And I think that's very important to call out. But there is a huge focus on that because we have a lot of work to do in that space. So I guess if you look back over the past sort of 12 to 18 months, it's been a huge effort put into AN-ACC optimization, different strategies in terms of supporting, to make sure that, I often say we can't afford to have any lazy dollars in this environment. The margins are too tight and what we're trying to achieve is too critical. So we've worked with third parties. We've invested in our own internal resources to ensure that we are managing and reviewing it as regularly as possible and using data and systems to inform that. I think one important part of that strategy and the journey, which some people, when I tell them, it comes as a bit of a surprise, but I don't know why, is just the interplay between our operations and our finance teams in achieving those outcomes. Because some people just rely purely on your finance professionals to get those outcomes, and because of the clinical operational nature of AN-ACC and the outcomes it's generating, that partnership and dedicated partnership, not doing it on a part-time basis, has been critical. The emergence of the ad services that you spoke to before has been a critical part in terms of our profitability and improving that over that period as well. So I don't want to underplay that because they go hand in hand. I mean, the stuff that Tyler put on the screen before, it shows you that it's not sustainable, really, the way it is. And when I talk about sustainable outcomes, it's covering your cost of capital, your capital budgets every year, being able to cover those and cover that cost of depreciation as a couple of basic rules of thumb. And we're not there yet. As an organisation, we've seen the bottom line and our EBITDA outcomes improve, and thankfully that's supporting cash flow as we move forward. But that net profit position is still not where it needs to be, and that's why this reform is so critical.
Yeah, thanks, Chris. Yeah, great points. Athena, over to you. Having trouble hearing you, Athena? Let's work on that. Let's skip back to Lee. Can we hear you, Lee?
Yep, thanks, Andrew.
Yep.
Lutheran Homes Barossa, as we are known nowadays, being a regional not-for-profit standalone facility, our aged care facility, whilst it makes a small deficit, our overall profitability of our business is certainly well carried by our retirement village input. We have a multi-campus site, so we have retirement village and CHSP. We also have a license for home care, which we haven't actually activated as yet. And that's because of the issue of employment. There's just not enough people out in the regional areas to put into employment. And so that's our biggest issue with, as Chris sort of indicated, and I think Tyler indicated, it's really playing that fine line about, are you compliant or are you profitable? It comes down to how well you can manipulate your rosters to meet both compliance and the needs of the residents. I'm not sure whether it's right or wrong, but we're very, very careful about what residents we actually take into our facility to ensure that we are able to maintain their care. We certainly meet the RN 24/7 requirement, but we struggle to meet RN minutes because we physically can't employ enough registered nurses in the regional areas. I'm not quite sure what the answer to that is, but it really comes down to, I think, as Tyler sort of indicated, the more registered nurses you employ, the further you go backwards.
Yeah, thanks, Lee. And the other thing you made me think about there, because we've talked about this before, is the cost of change. There's this underlying cost. Obviously, we've got the standards and the Act and all of these new things still coming. A lot of people are revisiting their systems because of, you know, the changing care minutes requirements and reportings and stuff like that. It's moved forward. Big systems changes, rostering platforms, other things, just to get that kind of information and visibility and reporting. Big data, obviously. So that's a hidden cost, the cost of change. Thanks, Lee. Tim, what are your thoughts on this?
I think in some respects I'd echo what the other panelists have said. The way I like to think about it, and I don't like to use the word profitability either. It's you know, I don't like playing those sorts of language games, but it is unfortunately such a sensitive word in our sector, and there are other words we can use that it's often easier and more straightforward from a communication point of view to use words like sustainable margins and things like that. But I think there's three ways you can think about building sustainability. You can look at the efficiency of your operations, and there's the focus on AN-ACC, the focus on meeting the direct care minutes and the role descriptions that go into those direct care minutes, making sure that residents are assessed and their needs are reflected in the AN-ACC claims, and all the sorts of all that sort of core stuff goes to some of the elements of efficiency that are relevant for residential care, and then there's the elements of efficiency that are relevant for all of us, all of our back office stuff. And I suppose as a large organisation, we're able to generate some efficiencies there that come from our scale. Then there's claiming value. And by that, I mean things like making sure that the accommodation price that's being charged reflects the value of what's being provided and reflects the sort of market. And I think it's useful to think about that in terms of claiming value, because that value is already being provided to the person. It's not really increasing prices. It's not taking something away from someone. It's actually just reflecting the value of the offering in the way that the prices are set. And that's been a significant focus for Bolt & Clark as an organisation, is making sure that those accommodation prices do reflect the value in the market. And I think that there's a sort of change there, because as occupancy goes up, there's an ability to increase those prices to some extent, whereas there may be more of a focus on just maintaining occupancy a couple of years ago. And then the last part, I think, is creating new value. And I think that's the hardest part for the sector, and that's something that I'm sort of keen to talk about later on in this discussion, because we spend so much time focused on those other parts, and they're the easier bits. But creating value is sort of less a science and more an art, and it requires more time and it requires investment. And we're in a situation right now where we've got so much uncertainty from the policy landscape that goes to the existing laws, but it also goes to all the changes we've got coming down the pipeline. And I think the hard thing from a budget point of view is we don't even really know what our budgets next year will look like, because we don't know what the AN-ACC price will be, and then that makes it difficult to drill down to focus on particular strategies. And there's also this temptation with the surpluses that are created by the transition to put that into various other sort of programs, because there's always more that we want to do, even though it's something that we know is only temporary.
Yeah, thanks, Tim. There were some really good thoughts there. Looking forward to hearing the next chapter you've got. Let's see if we can get back to Athena. Athena, can we hear you now? No, Athena, we can't hear you. Sorry. Not sure. Just check your settings and your mic settings, maybe. That's all right. That sort of thing happens all the time. Let's keep moving, and hopefully we can come back to you by the time we get to the next session. I did want to touch on some of those points that you almost started talking about too, Tim. Really interesting points. Actually, one of the points that you made about claiming the value of accommodation. I think that's such a great point, because you're definitely wearing the construction costs that are relevant today, and you're definitely wearing the cost of capital costs that are happening today. So you need to be recovering the cost of the property costs, and they're passing on that value and passing on that price. And I think with the industry on the whole, through a combination of policy and a combination of behavior, I'll talk about occupancy in a second, has been really undervaluing that property probably for a long time. So what do I want to do just quickly now is I just wanted to reflect on some of the things that we are talking to people a lot about at the moment. So here is the benefit of the distillation of all of those conversations for you to think about as you look at your own business. So first of all, assuming that AN-ACC is achieving that maximum margin, we've talked about that your rosters are efficient. You need to that's the biggest part of your revenue, and it's the biggest part of your cost. If you're not getting that right, you're too far behind to begin with. So get that right. So that's assumed here. And also not including revenue in addition from additional businesses. We know that there's a huge variety of businesses and structures and the other services that you run with. Lee, you talked about your retirement villages. That is definitely an option. We've got organisations that have large properties and other income streams, and that's particularly for some not-for-profits and charities. There's all sorts of income streams. So not talking about that, just talking purely about RAC and very related. Here are some thoughts that you should be looking at, and most of you probably are. So the profitability analysis generally, really having a total holistic look, and I think a lot of providers are guilty of not looking and taking a very tight scrutiny of some non-care areas, because traditionally, certainly for the last 10 plus years, it's been subsidised by ACFI income and really being able to drive bigger margins out of ACFI if you're managing that well. If it hasn't been reviewed in years, really need to have a really good look at that, those numbers holistically. So that's a general point. Some of the specific points, the bonds, the RAD money, there are many providers that we come across who their strategy for RADs is very much based on what they've always been doing. They've always kept traditional percentages of RAD money. A lot of that money is sitting on balance sheets and not doing a lot. Whatever construction work they've been doing in the past is long finished. And now they've sort of still got a similar strategy, but they're not really using that money very efficiently. Certainly the profile with interest rates is changing all the time, depending on the area you live in, and how socioeconomically affluent that area is. A lot of these variables change. Also remembering that RADs will be phased out in some way over the next 5 or 10 years. So is your strategy the way it is now, building in the fact that you may end up losing those RADs or not being able to replace them at some point in time? So there's a bit of a long-term view that needs to be thought about in terms of what you're doing, the short, medium and long-term view of what's happening with your RAD money. Additional services, of course, talked a little bit about that. Is there something that you can employ? Obviously, there are some external constraints. There's rules about what you can and can't do, and we're waiting to see to what extent that will change with the response to the task force report and recommendations and with the new act. But there's also we come across quite a lot of internal constraints. So some not-for-profit providers, particularly, it doesn't align with their value, or they've got a very high concessional rate where they won't distinguish between services provided for concessional and not the haves and the have-nots. So that is causing a lot of consternation and tension in businesses at the moment. The idea of doing additional services they put a lot of thought in it, but they actually find executing on that is very difficult, and you can lose money in the short term rather than make more money. So you've got to be very careful about the decisions you make in those areas and think them through. Supported resident ratios. We've had a couple of recent examples where they've been driving organisations, providers have been driving very hard towards the 40%, but happen to be in quite wealthy areas where maintaining that, hitting that 40% or even maintaining it's very difficult. That's just not their catchment. That's not the people who are coming to their facilities. So in actual fact, in this one particular case we're looking at, there's actually, it's more profitable. So you create more sustainable margin, Tim, from actually going down, not up. And so you're artificially trying to force that number up, where it's actually a lot easier to go down. So there's a lot of implications to that, and what, taking everybody that you can, and a lot of people's mission is aligned with that. But the point that we're trying to make here is with supported resident ratios, don't automatically assume that you need to try to go up to make more margin. That might not be the case. So look at that really carefully. Accommodation and occupancy, we find a lot of organisations have fixed mindsets about maybe where occupancy was 2 years ago or 4 years ago. We went through a very difficult period where wait lists disappeared and occupancy pressure was high, and that created a lot of mentalities and a lot of behaviours around what you can and can't do with competitiveness and room prices and discounting and all of that. We find there's still an enormous hangover from that, whereas most people we speak to, without many exceptions, have significantly increasing occupancy in their properties. So review that occupancy strategy, review that accommodation strategy in line with what is a contemporary way of thinking, and really understand what your competitors are charging, what the average property prices have been doing in your area. And I think this is also wrapped up in the consumer contribution component of the task force report, which is the daily living and the accommodation is something we all pay for our whole lives. So reflecting the true value of that, I think, is something that is legitimately needs to be looked at in aged care, and not necessarily a responsibility of the government to fund in that sense. So we'll see how that shakes out in the next few months, but that's definitely an area worth looking at. And other operational costs, we do have such a variety of clients and providers who really over time have increased the number of people in this department, or increase the number of people in this department, or, you know, huge costs in different operational areas. They've outsourced catering or insourced catering, or it's just a good opportunity to start looking at all of those costs, not really, you know, being constrained by any idea in the first case. Just have a look at those operational costs. What are significant costs? And challenge yourself. Is there a better idea to outsource, to insource? And obviously, and we're seeing both. We're seeing people do both, outsource support functions and finance and things like that, or insource catering. We're seeing lots of different variables where people are making those decisions now, how they can provide a better service and how they can provide it more efficiently, but also automation. There's so many fantastic opportunities coming down the line with AI and data and structuring, and just making so many repetitive tasks and labor-intensive tasks more efficient. So really looking forward to seeing how that plays out over the next 12 or 24 months across your operations. So hopefully there's some thoughts there. Hopefully you're looking at most of those. Certainly we're doing a lot of work in this area. So if anybody needs more support, reach out and talk to us. So let's go back to the panel. I know that was kind of a brief segue away from the panel back to the panel, but I think this is the meat and this is the meat of the conversation. What are we now doing going forward? So from the point of view of what does your organization do, or Tim, in your case, what is your perspective on that? But at the same time, not just your organization, but what do you feel that means for the industry to recover? Shall we try going back to Athena? Did you have any luck with that, Athena?
Can you get me now?
We can.
Excellent.
Yay.
Wonderful.
Take it away.
So you've actually covered off on a lot of things that we've done, Andrew. We're a regional provider. We've got 2 sites here. And I think it's fair to say that 12 months ago, we were looking at probably closing our doors. Things were very, very dire. So we did a lot of things. We started off with forecasting, had someone come in and do a whole lot of work around that, which was very helpful. We developed up a RAD strategy, which is working very well for us. And you talked earlier about the team getting together with finance, clinical, admission. So AN-ACC, we work very closely almost every single day, to be honest, looking at, you know, rosters and ratings and all that sort of thing. So we're lucky we have no occupancy problem up here. So we very, very closely look at the residents before they come in. We look at their AN-ACC levels. We try to sit probably around the middle, which seems to work well for us. We also look at the concessional ratios, so very different on both of our sites. So one's very high and one's very low. So as you said, it does make a difference when you're looking at the concessionals. It's not just about trying to sit at 40% kind of thing. We've gone for the higher RADs. We were successful with that, especially on our other site, which is a lot more upmarket than one of our others. So that's, and they're quite high. It's quite surprising for a regional area just what those values are. A lot of automation, a lot of money gone into all sorts of different electronic programs just to try and assist in the background, but we will never meet our care minutes, I don't think. You know, as Lee said, it's very difficult to attract people up here, and when we do, we have to pay a hell of a lot more money. So when we're not subsidized for that, or you know, in any way kind of so it's challenging, but it's optimistic. We're certainly a lot better than we were. We built put an extension on one of our buildings, finished last year, so obviously lots of money to pay off in there as well. So one of the things I must admit we don't worry about too much, the department and the commission might, is our star ratings. We basically ask everybody when they come in, survey everyone, what do you know about our star ratings? And out of 200 people, 1 said that they even looked at it. So it's much more, I guess we're fortunate maybe in a regional area that it's about reputation. So we try to be an employer of choice and you know, continue to provide that. that high level of care. But it's you know, rosters and staffing are by far our biggest challenges. So we're going offshore. That's the only thing we can do. And again, there's a massive cost associated with that, which we've had to build in. So, and now we're looking at future is definitely learning and development, training for our staff, because with all of the new people coming in, you know, you have to make sure that they know what they're doing. So yes, I think probably the key for us was the bringing together of all of the different program areas so that we're all on the same page, and we review those residents really, really closely. We try to filter out the ones where we don't like their families, but that's not as easy as anything else. So because that reduces obviously the amount of complaints that you get later on down the track, which is not really related to finance, but it's certainly related to reputation, which all just, you know, goes around in the same circle. So I guess really in a nutshell, that's what we're doing. We're now brought in a business development manager, and we're looking very closely at all of our other program areas, so home care, CHSP, and how we can maximise all of the revenue that comes in through there. So that's our next big focus for the next 12 to 18 months.
And what modified Monash are you?
Yes, now that's about, I know we talked about this the
Didn't
other
want
day.
to open a can of worms. Yeah.
Yeah, that is a can of worms. We're a 2, which we're very upset about, because it means that we're just not eligible for most of the other, you know, funding or other grants and things that are out there, which is, you know, when you consider where we are, it's quite extraordinary. So I do believe that there's got to be some work. I have tried to do some work on this, but at the moment, no one's listening. So if anybody's got any clues out there about how we can manage this, it would be very, very helpful.
Yeah, just a quick ad then for there is a capital grant that is open right now, and they had a round of it that was 5 to 7, I think, but it's now been opened up to 2 to 7.
Yes.
2 to 7 is now open.
Yep.
Anybody looking at building or constructing, it's very competitive. We do support these applications if you need some help. But yeah, definitely check that out and get your application in if you're thinking about building. You did yours last year, but thanks, Athena. Thanks so much. Thanks for persevering as well. I think really interesting about paying premium for the staff. I think it's really, really tough, but it sounds like you're endorsing like my last slide, which is you really have a look at everything, and the cumulative effect of those things starts to really pay off. Thanks for that. I don't think David's on the line still, unfortunately. So let's walk backwards and go with you, Tim.
Thanks, Andrew. I think as we sort of look forward, we are in a bit of limbo at the moment because we don't know all the policy settings. Hopefully, once the next draft of the Aged Care Act comes out, or even sort of as a separate announcement of the government's response to the task force, we'll have a little bit more clarity on the direction that certain things are going in. It's possible that coming out of the task force, there'll be changes to the rules around additional services. It's certainly likely there'll be changes to consumer contributions in some places, and then that influences your ability to charge extra in other ways. So if government's going to require people to pay more through a sort of a higher basic daily fee if they're a non-supported resident, then you need to sort of think whether you can ask them to pay that and then ask them to pay extra for a new additional services program on top of that. So it does sort of create a bit of an uncertain environment. We were hoping to have a bit more clarity on that at this point, but hopefully that won't be too far away, at least in a directional sense. I think there is a lot of opportunity around this sort of creating value space and around additional services, but it's not realised because, in part, because of the amount of effort that's required to develop those value propositions and cost them out and test them and put them out into the market, and then the uncertainty about what the regulatory response to some of those things is going to be. And there is a history in the sector where there's an expectation of everything being included. So charging more for something, even if it's not part of the basic value proposition, can sometimes be viewed a bit negatively. So overcoming those perceptions is part of the challenge. But I think, you know, I think not many people in the sector sort of have really spent the time going through that sort of product development process that any normal business would, with respect to sort of additional services products and talking to their consumers and figuring out what they actually would pay more for, particularly as we're seeing the baby boomers come through with a different profile of expenditure expectations. So I think there's real opportunities there, and to some extent the delays created by the new Aged Care Act, by the task force response delays, gives providers an opportunity to do some thinking, so that when those new rules do come into place, probably from 1 July next year, you are in a position to launch whatever your whatever new programs you've come up with in the intervening period.
Yeah, that's a good point, Tim. Yeah. Your dogs don't sound very happy there, mate. And you're actually you're setting off my dog, which is funny. She's walking around going, where are those dogs?
So sorry about that. Sometimes it filters it out, but it obviously didn't.
Someone's not breaking into your house or something. Perfect. Thanks, mate. Thanks for those comments. Really, really interesting. We might come back to a couple of those, but really one of the things that interesting me around additional services is whether you can actually the whole point around allowing someone to sign up to something beforehand or not. So there is actually going to there might be more flexibility, and then also some more constraints. So, but not requiring people to sign up once they're in and things like that might actually take away that one transaction kind of process. And it's going to be interesting. It's going to be interesting, and we won't know until they come down with the detail of it, and we never know until we can see the detail of it. We're very highly regulated, and I think most people I've come across in the industry are very skittish to try something new until the detail's there and they know what they can do and what they can't do. So we'll see how that plays out. Lee, what are your thoughts on that?
I'd just like to follow on just what you've said there, Andrew, as in our organisation, it is all about the risk appetite of the board and the executive and staff. And I firmly believe that in today's aged care sector, it's about trying new things outside the box. And so the risk appetite needs to be high. And I put that into context with the fact that Luther and Holmes Barossa have for the past 4+ years deployed robots to assist back of house tasks that make doing repetitive jobs like pushing trolleys or moving around linen and clothes and food and so forth far more safely and more efficient, because machines can do it safer and more efficiently than what people can. It really comes down to we're lucky enough in our organisation that we have 100% occupancy. And, you know, no sooner has someone passed away, we've got someone else in the bed, because the numbers in the Barossa Valley are like that. It still comes down to the fact that someone put in the chat about the concessional ratio. We don't have any trouble meeting our concessional ratio, just like we don't have issues with people paying the maximum RAD that we have either. So there is that playing those sorts of games.
Thanks, Lee. I think one of the interesting things that you just started pointing out there is it does amaze me, 2,000+ facilities in Australia, that as much as almost every single one of them is unique, even within the organisation, so many things that happen in that facility are, whether they've been related or they've grown up in completely separate ways, are done exactly the same way. So there's so many things in our industry that everybody does the same way, and then another myriad of things that everybody does differently. So it creates a lot of complexity when you look at most policy at 40,000 feet, which is a one size fits all, more or less. So it's no wonder that we struggle with how that fits everybody when you think about those kinds of variables. Chris, what are your thoughts?
Yeah, thanks, Andrew. Geez, there's a lot to process in all of that. I mean, going back to those slides, the one thing I was thinking is that, we should, or as an industry, you should be on top by now of RAD pricing reviews, additional services implementation, a process to manage your concessional supported ratios. After the storm we've been through with COVID and underfunding, it's incumbent as managing the organisation. Those should be built in to structures, to processes, to part of our reviews. They should be bread and butter. So if they're not in place and you're not effective and efficient in that space now, you're behind the eight ball. We left additional services a little bit later, but they've been in place for a good couple of years now, and I felt we left that for a while because we struggled with implementation. So that's the first thing. When I'm looking at those things, I'm saying you really need to be on top of those. Then you come out to the emerging issues, which we've seen over the last couple of years. And, this whole agency issue of agency, start labour hire. The trick with labour hire is it's a necessary evil. It's not only the cost, but it's what it does to the continuity of care. And with our relationship-based care model, it's really been disruptive. So we are trying to, as everyone is, reduce the use of agency as much as we can. The two parts to that is control. We ended up putting in a portal with a third-party provider to put controls, because, you have desperate services who are making decisions that aren't always the most effective. So you support the decision-making process with that control mechanism. And the other one is bringing your people and culture team and having effective recruitment and retention strategies to bring that down as well. And I say that as a larger organisation, so we have more resources, but battling that agency cost and that is really crucial. And of course, the accommodation around that. We ended up in some of our regional locations purchasing houses because of the rental. It was just more effective to purchase houses out there. So that's the second bit, is getting on top of that as best we can. The other thing is that there are so many efficiencies in these regional settings that you need to call them out as well. The funding isn't effective enough or sufficient to cover the cost, the agency costs, the premiums you pay for goods and services out there, construction costs. It's just not enough. Whitten was at the forefront of the advocacy that had M5 included after that AN-ACC release. We played a big role with our local members in bringing that back in, and there's more to do. As I've said before, it's ridiculous that a home in Mossman a home in Moree, which we have, is classified the same way as a home in Mossman. That's kind of insane when you think about that. Another point just to sort of raise in this whole cost structure issue is good care right now in Australia with the funding model. It requires inefficient spending. And I'm not saying you go and do that, but for example, the 200 care minutes, the 215 care minutes, in our view, in my view, it's not enough. We're not funded to go beyond that, but we get this information and feedback from residents and employees daily, and we comply with those care minutes. I think you could put a 3 or a 4 in front of that number, and you might be getting to where it should be. But without the funding, you can't do it. And the other thing is things like food. We deliberately overspend on food to deliver the food service that we want, and it reflects in our surveys. Our surveys for food are pushing 90% satisfaction, which is kind of crazy in aged care when you think about it, but it requires expenditure which you would label inefficient. Just finally, in terms of moving forward, I think there's a big role for that whole data and BI to inform better decision-making and reduce time on task. Looking at your other revenue sources from retirement living, reviewing your DMF models, things like that. Home care growth has been crucial in supporting our business plans as well. And just continually to optimize, look at those major contracts and looking at those outliers in the P&L to make sure you're getting bang for buck. And the last thing I would just say, the task force recommendations, I was quoted in the Australian today because I'm just over waiting for these guys to make a damn decision about where we're going with this. The task force recommendations are the answer to a lot of these problems. I don't necessarily agree with co-contributions. We are asking one part of one part of our resident base to do the heavy lifting, but it is what it is. Those co-contributions will play a role, and these guys need to get on with it and make a decision so we can all plan for the future.
Yeah, Chris, thanks so much. A lot in that, but couldn't agree with that or more. Yeah, terrific thoughts. We did hear a rumor that I feel stupid saying it almost, but a rumor that the task force report will drop in the next week or so. So imminent, maybe even this week. So I hope that's true. Just like all the rest of you, just need some certainty. No understanding what that is. We do appreciate though that the government has taken their time to get it right. So really looking forward to seeing what comes out of that. Thanks everybody. I just wanted to check quickly. Was there anything in the chat, Katie, that came up that was worth mentioning?
No, not particularly. Not that it hasn't been answered. There was a little bit of commentary around the changes to the RAD pricing, but I think we touched on that. And if anyone has any further questions, pop them in there and we'll come back to you.
Yeah. Okay.
I did see a question regarding national trend of the supported resident ratio. So there was quite a bit of chatter just regarding how people approach that differently. But nationally, it's always been 40%. So that policy that just sort of defines the accommodation supplement being at the higher rate or the lower rate aligns directly to how they control means testing. So the levers that they have around income and asset testing means that the industry average is always going to be right at 40% concessional. But I think further to that, one of the things that we really foresee occurring is services that typically try to ride that margin or get very close to that 40% ratio. They want to be just above it, 41, 42%, depending on how big their service is. Probably moving away from that. So for services that struggle to stay above 40%, we do see a strategy that moves them much lower, mid-20s, the mid-teens, versus services that want to move well above 40, into 70, 80%. So I think that's more of the trend that we're seeing.
Yeah, thanks for that, Tyler. I did want to just reflect on a couple of things. We are doing a lot of this profitability analysis. It is a strategic way. And like Chris said, if you're not looking at all those things, you certainly should have, and you should have looked at them quite recently, I would argue, just to see what has changed, because things are changing all the time. If that is a need, it's a fairly simple process. Definitely get onto that. It's a great place to start. We've developed a number of strategies for clients in the last few months, which has given them a 2-year, 3-year view of where they're going. And then when we start getting this information, like the task force report, we can just adjust the strategy, but at least there's a plan and everyone's moving in the same direction. And it's not always where we start, because we take this strategic approach. It's not always where you think. Quite often we take a left turn and end up doing something a little bit different, which is interesting. Really wanted to touch on this though. Also, our next webinar is the workforce challenge. We really want to bring some more information to you all about the workforce challenges. Our view on it this time, the take we're going to take is we're going to have a look at a couple of things. First of all, making sure you're understanding the importance of getting workforce efficiencies, so using your resources, particularly the care resources, efficiently. But the other angle we want to bring is our friends at Lockton have a lot of advice around the cost and impact of employee well-being and the entire employee journey, the cost that's having on the cost of absenteeism, the cost of the impact on workers' compensation insurance, really investing in employee well-being and employee experience is actually a financial outcome. It's actually reducing cost. So join us for that. Trying to get some more ideas around things you can do to manage employee costs and employee welfare altogether. So it is the biggest the issue for the industry. So that you've got to treat the people you have well. A penny saved is a penny earned, as they say. So keep the ones you have. Retention's important. Look after the ones you have. And while you're trying to attract new staff. So we really want to tackle that next time. We look forward to seeing you there. Thank you so much for joining us again. We continue to bring you these webinars because we think we're filling a gap where this kind of information is really valuable. We hope you agree. Love to have more comments about what other things you'd like to hear about. We're very open to that. Thank you so much to our panelists, to you all, Athena, for persevering, Chris and Tim and Lee. Thank you so much for dedicating your time. That's what makes these so valuable. So thank you again for making time, and thank you everyone who turned up to contribute and to listen. Have a great rest of the day.